Before going into depth into some of the other charts in the book, let's think about what Thomas Piketty outlines as the two theories why we have this increasing income inequality in the United States. One theory is that it's driven by labor. It's driven by labor, and in particular, you have this phenomenon. So you have this phenomenon where top managers, so we're talking about executives maybe of large corporations, are getting a larger and larger share of income. Larger share of income. And he argues that this could be due to one of two reasons, or maybe some combination of them. One might be the market just recognizing the value or the importance of having top managers. And so over the last few decades, the market has realized, hey, it's worth it to pay these folks more and more and more money, because even though those are large salaries, these are very, very large enterprises. And if you can measure that someone can drive a 1 or 2 or 3% better return on capital for a multi-billion-dollar company, or drive the growth faster for a multi-billion-dollar company, then maybe it's completely worth it to giving them a larger and larger and larger share of income. So one possibility is just the recognition. So let me write it this way. This is the market recognition of value. Market recognition of value. But another thing he cites, and he actually implies that this is what he believes is the more likely one, is that over the last several decades, you've had situations where the top managers have been able to essentially control what they themselves get compensated, and there's not a lot of checks and balances there. So this is the one that he actually argues is probably happening more. So you could almost say this is a kind of a self-regulation of income. Self-regulation, and most folks, if they're allowed to self-regulate their income, would tend to increase it, or maybe it is a combination of both. So this is one dynamic that he argues could be driving this increase in inequality, that top managers are getting a larger and larger share of income. The other one is driven by capital. So the other argument is one based on capital. So capital. And it's all around the idea that if the return on capital is greater than growth, then over generations, those who have capital, especially those who generate a disproportionate share of their income from capital, are going to, if their proportionate income, their proportional wealth is going to become a larger and larger and larger share of the economy. What do we mean there? Well, if most of your income comes from just your labor, then your salary is just going to be based on market forces for how much value you might be able to add to a organization, and how many other people have that skill, and your negotiating leverage, and all of those types of things. But if most of your income starts to be generated not from labor, but from returns on capital. So what do I mean by that? Well, let's say that you are a doctor. You are a doctor. And let's say you make $200,000 a year. So $200,000 a year. This is, let me do this in a color that you can actually see, $200,000 a year. This is your income. This is your income from labor. Income from labor. But let's say that you've come upon some inheritance, and you have a $10 million inheritance. So you have a $10 million inheritance, and you invested, and you get a 5% return on it. So your return on capital is 5. So you get 5%. So let me write this as R is equal to 5% here. R is equal to 5%. Well, 5% of $10 million is $500,000. $500,000 per year. So this right over here is income from capital. Income from capital. And so his argument here is once you get to a certain point and you start having a lot of capital, and if your return is greater than the growth in the economy, well then this doctor in this example, his wealth is going to go from 10 million to 10.5 million. That's going to grow by 5% again. Year in, year out, it's going to grow faster than the economy. And then he could I guess, bequeath it to his children or to someone else, and then they will be able to compound in the same way, and that over time you might have some form of dynastic wealth, where wealth is being driven really, they don't really need to have a job, and just this phenomenon by itself, where you inherit some money, you invest it at a rate of return that is growing faster than the economy, and so this over time is going to take up a larger and larger chunk of the economy. And I'll do a spreadsheet to kind of to show at least this dynamic. Now, he also points out that, look, there could be other dynamics that balance this off. In fact, maybe this is one of the dynamics that really, I guess you could say, valued labor, and we see that in some areas, whether it's sports stars or maybe in finance, where the best hedge fund managers or portfolio managers get a disproportionate share of income. Maybe some of that is justified, or maybe you don't even get these returns. You need some of it to go to labor. But then you go the other way as well. When people get huge labor income, that might allow them, or potentially the people that they bequeath their money to kind of go into this category right over here, where they're getting a lot or all of their income, or a disproportionate share of their income, from the return on their capital as opposed to their labor. And this whole idea is really that you're just going to have a higher savings rate if you have a large income. And actually, let me make that clear as well. So for example, if let's say there's two people, one person, so person A and person B, let's say person A makes $100,000 a year, $100,000 a year, and let's say that person B, let me do those in the right colors. Let's say person A makes $100,000 a year, and let's say person B makes $1 million a year. Actually, let me just write it this way. Makes $1 million a year, so that's their income, and we're not even saying how it's coming to them, whether it's labor or returns on capital. So that's their annual income. Now, person A, you could consider them, I guess, upper middle class. They might have, a mortgage or house payments, send their kids to college, whatever. Their expenses might be $80,000 a year. Expenses are $80,000 a year. And let's say this is after tax, just to make it simple. This is after tax income. So their expenses are going to be $80,000 a year, and so they will be left to save. So their savings are going to be $20,000 per year. Now let's say person B, their after-tax income is $1 million a year. Now they are able to live a more glamorous life, I guess, and so they might have more expenses. Maybe they spend, and maybe their families are the exact same size. Maybe they spend, 5 times as much money. So this person is living a much more consumptive lifestyle, I guess you could say. So they're spending $400,000 to live, and so their savings are going to be $600,000. $600,000. And so you see this idea that this person right over here has a 20% savings rate. They are saving 20% of their after-tax income, 20K out of 100K, while this person right over here has a 60% savings rate. Now, it's completely possible that this person could really, live large and spend $800,000 a year. But it's this phenomenon that the larger that this goes, it's actually hard to spend that much money. In fact, you could imagine if someone with a lower income, $40,000 or $50,000, where they have to spend all of their money and they actually have zero savings. So as your after-tax income becomes larger and larger relative to your standard of living, your cost of living, the savings rate generally goes up, and because the savings rate generally goes up, you start to go more into this category right over here, where you might benefit from returns of capital, especially if returns of capital are growing faster than the economy. And another question to ask is, well, do you think this could happen over very long periods of time? So once again, my point here is to really just articulate what's going on in this, what now seems to be a pretty popular book, but you should look at this one with an open mind, but also with a critical mind. Does this make sense? What are the balancing factors? Why this might not continue forever? Why R can't be greater than G forever? Or why this might break down, or why this won't continue on and on forever?